Matt Orton for more on the global markets as well as emerging markets, which he tracks very, very closely as well. Matt, always a pleasure to have you on. He's, of course, Head of Advisory Solutions and Market Strategy, Chief Market Strategist at Raymond James Investment Management. Do you think that the Fed possibly not cutting rates once again becomes a big talking point as far as U.S. markets are concerned?
Hi, good morning, Tamana. It's always great to join. And I do think the Fed and the moves related to the Fed are really the main culprit behind a lot of the, I'll say, pullback, softening investor sentiment that we've seen over the past couple of weeks as the market slowly moved down from its all-time highs. And in the absence of any firm economic data, everyone's been focused on Fed speak, and Fed speak has made a decidedly hawkish turn, with a number of Fed members either outright saying that they will not support a rate cut in December, or saying that we're not certain yet, which is very different from where we were 1-2 months ago. So the market's recalibrating to that. And frankly, I think the price action that we've had, especially a lot of money coming out of unprofitable assets, a lot of places where there was froth in the overall market, it's healthy. When you think about the rally that equities have had from those April 8th post-Liberation Day lows, we haven't had anywhere near a 5% pullback since April 8th. So it's healthy for markets to have a sort of correction, both through price and time. And what else is very encouraging is while the Fed is in the background, you're seeing some healthy rotation beneath the surface. Healthcare, energy, financials, all have been quietly outperforming. So this idea that we've been telling clients to build balance in portfolios, I think remains very, very valid, while still leaning into and perhaps using this downside opportunistically for high quality assets that might be levered towards the AI trade.
Matt, good morning, and good points that you're making. I just wonder, and you pointed out the Fed in the background there, but then there's now increasing consensus that you might just have to do with no cut in the next policy. How much of a drag will that be in the near term? And is that, or for example, is that going to be taken as par for the course and you look forward to the next policy where there could well be a cut?
So Alex, I think the markets are great at looking forward. So a decent amount of recalibration is already baked into the market. So we're about 40% looking for a December rate cut. I suspect a little bit more probably gets taken out after we get a jobs release on Thursday, as stale as that might be. And I also think the market's going to be disappointed that we don't really get any usable economic data up until very close to the FOMC, if not after that, just because of delays and difficulties in calculating numbers because the government has been shut down. So there is the risk that you could see volatility pick up. And I think that could infect some of the systematic flows that are, risk parity funds, CTAs, vol arbs that tend to sell equities as volatility increases. But again, a lot of that price action has happened over the past 2 weeks. Positioning to me looks fairly healthy. And also we've seen a lot of retail interest continue in the overall markets. We had one of the strongest weeks of the year last week. I think some odd 13 billion US dollars flowed into US-based ETFs. So that's very, very strong. And I do think high quality assets, investors will be willing to buy the dip because earnings have been so strong. And regardless of what the Fed does, that's not going to change the path of earnings for a lot of companies that are levered to very long-term, durable growth themes.
Matt, good evening, Neeraj here. And I read your note very interestingly. You have trimmed exposure to what I would call AI plays as well, South Korea, for example, and you've upped the overweight or upped the weight on India and your exposure to India as well. Why that call?
So emerging markets, Neeraj, have been very, very strong this year. There's been a huge run in Korean assets, Taiwanese assets, anything levered to semiconductors and artificial intelligence. So it's not to say that those trades don't continue to perform, but I would argue there's probably more valuation concerns there. And as I look to the future of the AI trade, I think it's going to be less in semiconductors and more towards the bottlenecks, the actual providers of compute, your data centers, your power companies that enable the compute to actually happen. So that's where I'm looking for more opportunities. And when I look at the emerging market complex, a country like India has underperformed significantly the broader EM area, but you're seeing much better earnings. And that's been a huge reason for India's underperformance. And there's a lot of great companies in India that, despite the overall market's underperformance, have done well and have continued to post very, very strong earnings. So look at some of the auto names. M&M, one of my favorite names, that's continued to just provide great earnings strength. Farm crushed the numbers. You saw really, really good strength across the automobile segments with a really, really healthy list of cars that are continuing to be launched. You look at even more industrial names like Adani Ports. You're seeing management really execute on building a better ecosystem for all of its clients. So there's a lot of areas of India that I think look fairly valued. And I want to be putting my money into work where I think I'll see outperformance next year and not chasing returns into the end of the year.
Matt, I wonder if you're looking at Indian IT as an anti-AI play, and a little out of syllabus question, but are you looking at what's happening in the Indian primary markets at all?
So unfortunately, I can't participate in any of the IPOs, but what I'll say, Tamana, is it's encouraging from a risk perspective. It's really encouraging to global investors to really see the dynamism of the Indian startup market and also companies wanting to go public. There's a lot of good companies that are coming public that are related to, I think, growing trends with respect to the overall consumer in India. So that, to me, I think is positive for risk assets, and they've been received fairly well, I would argue, especially relative to other IPOs in other areas of the world. When I look at the Indian IT ecosystem, I don't want to call it the anti-AI trade because they're still levered to, say, AI build-outs and developed financial companies in America and Europe. And I still am not constructive on the Indian IT market. I still think there's room for improvement. I'm not getting the best visibility from management teams when I look over where their growth is going to come from. But I do think we're getting closer to a bottom, and maybe in the next quarter or two, it could be time to start putting some money to work.
All right, Matt, thanks so much for joining us this morning. Absolute pleasure as always.